Thank you for the invitation. Nice to see you again. I think most of you would agree with me that the economic, or the news flow, if you wish, with regard to the economy hasn't been very great of late. CEOs, generally speaking, are pretty downbeat. Consumer confidence levels are low. And generally speaking, the prospects for the economy aren't that favourable. What I'm going to do, or what I'm not going to do, I'm not going to add fuel to that bad news flow. Instead, what I'm going to do, I'm going to show you a number of very interesting divergences that I'm picking up in the macroeconomy. And whenever there's a divergence or a disconnect between two lines on a graph, that has my attention. I'm going to show with you a number of pictures that fit that description very nicely. And in the process, we'll talk a lot about the economy. I will cover a lot of ground, and towards the end, I will also say a few words regarding this apparent disconnect between a weak economy and what seems to be, on the good news side, what seems to be an improving residential property market. So I'll share with you a couple of thoughts on that as well. So let me talk about, for lack of a better word, spot the divergences, or lack of a better phrase, spot the divergences in this presentation. The first one talks to what we are seeing in the global economy and the exchange rate. Now the data goes back to 1998, and what you're looking at there, the dark blue line is South Africa's real effective exchange rate. All you need to know is that the dark blue line falls, the currency weakens, if it goes up, the currency strengthens. The light blue line is the Global Purchasing Managers Index, which is a proxy for global growth. Now what is very striking about that picture, if you go back in time, is the positive correlation between the two. If the world economy is strong, historically the rand tend to be strong or appreciating, and quite the opposite also applied, but not of late. Very interesting is that exporters truly have a very favourable set of conditions. They have improving demand for their product, right? Global economy is picking up. The light blue line is above 50, which means the global economy is expanding, but at the same time, the currency is also weak, improving their competitiveness. Very unique set of circumstances. We haven't seen this for quite some time. Against this backdrop, it is not unrealistic then to think that our external side of the economy should be doing better. It is not unrealistic then to expect exports to perform under these kind of conditions. The question, of course, is the economy showing signs of responding to this on the supply side or the external side? Very interesting, the answer is yes. What you're looking at there is the year-on-year growth rate of export volumes, so it's volumes in aggregate, everything that we export, goods, services, and so forth, and the year-on-year growth rate of a very low base in 2012, early 2013 has picked up nicely, and obviously that most recent decline owes a lot to the strike activity we had in the first half of 2014. So without that, there's no doubt that the underlying trend in export volumes is up. This is what you see in level terms. The red bar in the third quarter of 2008, that was just before the global financial crisis. Exports in level terms as a percentage of GDP peaked at about 28%. It dropped quite significantly, obviously, in the context of the global financial crisis. In the third quarter of 2009, that's when the economy bottomed, and it was at a low 22%. Since then, exports in level terms have picked up to about 26% of GDP. In other words, for all of these constraints that we know of, electricity, problems at the ports and the harbours, whatever the cases, they're certainly not preventing exports from growing. What they are doing is that they're preventing exports from growing at the rate they should. Related to the whole issue of the currency and the global economy is another interesting disconnect. Once again, if you look at two line graphs, two lines on a graph. Another interesting disconnect, and this one talks to what we're seeing in the tourism industry. And we are, at least if you look at the data, we're certainly experiencing a boom. The blue line is travel receipts, the red line is travel payments. And you can clearly see from the blue line that it has well surpassed the kind of peak levels that we've seen related to the Soccer World Cup. What is also interesting is the red line. Now this is a function of locals traveling less abroad, spending less money abroad, where the red line is actually falling. In contrast, the blue line is picking up as more foreigners come to South Africa, and if you look at the increase in rand spent by them. Now what is very interesting is the picture on the right. So if you look at the difference between the red line and the blue line, you get net travel receipts. Now that would be the green bar on the right. Then I've also included on that graph the trade balance, which is the difference between merchandise exports and merchandise imports. And then what I've done, I've calculated an orange bar, and that orange bar is the trade balance adjusted for net travel receipts. And what is very notable about this is that in 2013, net travel receipts almost came to 60 billion rand, which is quite substantial. The trade deficit, on the other hand, was about 73 billion rand, which means that the difference, the trade balance adjusted for net travel receipts, only came to 0.5% of GDP. Right? Not bad in the context of all this negative news that we have with balance payments and our big trade deficits, whatever the case is. If you take into account what's happening in tourism, the picture is less bad. Still, what is very interesting about that slide is that you can have this favorable development in tourism, and it actually helps you a great deal in reducing your overall trade balance, but still, last year we ended with a current account deficit of 5.8% or almost 6% of GDP. So the question is, what gives? Now let me just give you a very simple little lesson in economics, and I will fill in the blanks, and it will become clear where our problems really are from a balance payments point of view. Net SACU payments come to about 1% of GDP. The fact that 90% of South Africa's trade volumes are seaborne means that net transport payments is 1.7% of GDP. The fact that foreigners own almost 40% of South Africa's bonds, and that foreigners own perhaps even more than that of South African equities in issuance, it means that the dividends and the interest that we pay to the rest of the world comes to around 2% of GDP. Quite substantial in the bigger scheme of things. The bottom line is, if South Africa ever wants to run current account deficits on more manageable levels, 3-4% of GDP, we will probably have to run trade surpluses in the context of some of those issues. Okay, let's move the conversation on away from the external side of the economy, trade-related, currency-related, into the consumer space, then into the corporate space, and then lastly, a few words about the residential problem market. Once again, all you need to understand from that picture is that if the green line falls, the currency weakens. If it goes up, the currency strengthens. Here we're looking at the Rand's Trade Weighted Index. And superimposed on that slide, going back to 1996, a couple of inflation episodes. Right? Now, obviously, the whole inflation story and what influences prices are quite complicated, but it is striking from that picture that whenever South Africa experienced some kind of inflation episode, severe or not so severe, it coincided with the green line falling. It coincided with currency weakness. And this time around, obviously, it is no different. In other words, while you have a weak currency on the one hand helping the competitiveness of manufacturing exporters, go back to the first slide, weak currency and improving global growth should be good for our exports. Signs are that it is already helping to support that part of the industry. At the same time, weak currency obviously leads to inflation, so it is a double-edged sword. Now, just know one thing, that there are a lot of factors that influence consumer spending, but everything else constant. If inflation goes up, your real income growth will slow down, and it is real income growth that matters when it comes to consumption. Everything else is secondary. But if you plot real income growth and real consumer spending on the same line, it's pretty much identical. Inflation, in other words, is key when you think about consumption. If you dissect the retail sales data in a little bit more detail, And here I'm showing you a couple. Once again, an interesting disconnect emerges from the data. Here you're looking at consumer spending on food, textiles, passenger cars, pharmaceutical equipment, or medical products, furniture, appliances, whatever the case is. And there are two that reads on the right-hand scale, passenger car sales, furniture, appliances, and everything else reads on the left-hand scale, and it's year-on-year growth in volumes. Now clearly, if you look at that picture, you will understand where the pressure is. The pressure really sits on retailers selling discretionary items. And discretionary items, in this case, would obviously reflect passenger cars, furniture, appliances, and so on and so forth. Reading on the right-hand scale, both those lines have eased quite dramatically and are showing negative growth. In contrast, growth when it comes to food, textiles, and so on and so forth, yes, it is slowing down, but at least it is still positive. So the pressure is when it comes to spending on discretionary items. One thing that we've learned when you think about consumption, when you think about the broader economy, is to really understand that not all consumers are alike. Similarly, not all retailers are alike. Some of them are performing better despite the tough economic conditions than others. What is interesting data from the Bureau of Economic Research, and this relates to the financial position of consumers in South Africa, is a very simple question that the BER asks in their particular survey of a couple of thousand consumers. The question relates to the financial position over the next 12 months, and the question is, do you perceive your financial position to improve or to stay the same or to deteriorate over the next 12 months? This is a net balance, and this is the end result of a survey that is conducted every quarter by the BER. What is notable, once again, another disconnect. The blue line is going up, the red line is pretty flat. High-income individuals feel pretty good about their finances. Poor individuals, or consumers for that matter, are not so upbeat about their finances over the next 12 months. What's going on here? What are the reasons that can explain this divergence? I can imagine you've got a couple. I just want to list four, particularly focus on the high-income individuals first. 4 reasons why. Well, high-income individuals tend to be skilled. Skills in South Africa are relatively scarce. Scarce skills come at a high premium. This group of people tend to have inflation beating wage increases. Their salaries goes up by more than consumer price inflation. They tend to own equity. They tend to own their property. The stock market rallies and house price inflation goes up, it often generates positive wealth effects. And here the theory is very clear. Positive wealth effects boost confidence, and confidence often translates into spending today. What is also very interesting is that this group, high-income individuals, also tend to own a fair bit of debt. And they have seen the benefit over the last 4 or 5 years of a significant cutting cycle. In the process, a huge amount of cash has been freed as interest rates have come down dramatically the last couple of years. In other words, what happens with interest rates will then be critical when you think about at least this grouping of individuals. On that score, let me tell you or share with you a couple of thoughts of how we see the interest rate cycle develops. The heading may come as a surprise to you. Why do we only see 150 to a 200 basis point hiking cycle, of which you've already seen 75? Why do we see that when history is clearly against us? That data goes back to 1990. You can clearly see that South Africa has a history of very violent and painful hiking cycles. The minimum by which interest rates are going up in the old days has been 400 basis points. And here we're talking about a cycle potentially half that. But it's also a brave statement to make, is the one that I'm doing, but why is it brave? It is because we're saying that it is despite currency weakness. Every time when we had a severe, painful hiking cycle, it coincided with a bubble. That blue bubble represented the currency bubble. This time round is no different, and yet we think interest rates will go up by less. Why do we say so? Well, I think it's quite important that you have to take a business cycle approach when you think about monetary policy in Ethiopia. What is striking, if you go back in time, is that the economy undoubtedly was in much better shape at any of the previous occasions or episodes when interest rates increased dramatically. In the year or so leading up to every previous hiking cycle, with the exception of 1998, the economy was growing at 3% and much faster than that. Go back to 2006, 2007, the economy was growing at 5%, if not more. This time around, as we all know, the economy is relatively weak. Growth is pretty poor. HCE, that's household consumption spending. Growth in consumer expenditure also, no surprise here. Whenever we had a severe hiking cycle, the consumer was spending much, much faster and much, much more than they are today. Real growth varied from 3%, 5%, 7% at stages. This time around, it once again sub 2%, slowing at around 1.8% or so. What you're also seeing on the screen there is leverage. So here I'm looking at the debt to PDI, personal disposable income ratio, and what is interesting that over that, how many years, leverage has picked up quite dramatically over the last couple of years. So when you think about an average household, the debt to income ratio is about 75%. Why is that important from a monetary policy point of view? Well, obvious. The higher the levels of leverage, the more sensitive consumers are to changes in monetary policy. And hence why the central bank this time around will have to be a little bit more cautious than they have been in the old days. Perhaps they're already there. Remember, we are now moving in 25 basis point increments, and not 50 basis point increments, as has been the norm up to now. Lastly, and once again remember, we're arguing here that why, despite currency weakness, will the hiking cycle not be as severe? I talked about growth, I talked about the consumer, I highlighted leverage, and of course the missing element is inflation. Interesting that every time when we had a painful hiking cycle, inflation was much, much higher than it is today. Go back to the early 90s, inflation peaked at 11. Then later on, 2001, thereabouts 13%. 5-6 years ago, inflation peaked at almost 14%. Can you remember that? Interesting that in this context, people complain about inflation at 6.5% being high. Right? It doesn't really matter how we squeeze our econometric models, we cannot get inflation even close to those kind of levels associated with the painful hiking cycles we had in the old days. In conclusion, what is very important here is that currency weakness, yes, it matters. I earlier showed you that if the green line went up, inflation follows. That's not the point. With currency weakness, yes, you will see inflation, but what is very important is when currency weakness happens. If currency weakness occurs when the economy is weak, you don't have to be too worried about inflation, because under those kind of conditions, companies have limited pricing power. I speak to a lot of people, a lot of corporate clients and so forth, and what is very simple, and a reflection of the tough economic conditions we are in, is that retailers simply do not accept price increases from suppliers nowadays. That reflects the level of intense competition. And as those forces work their way through the economy, it helps to contain inflation. I think that is exactly where we are. In other words, not that currency weakness doesn't matter, but what matters is when the currency is weak. If it's weak when the economy is weak, I don't think inflation will be a significant problem. Alright, so hopefully this view pans out. Hopefully this cycle is a little bit different. It will certainly help high-income individuals a great deal when you think about consumption. Right? The other part, maybe just before I go on to the low-income consumers, if you want to talk risks, there are two possible risks. No doubt that you have to keep an eye on when you think about high-income consumers and what they do with their money. If the stock market experiences a correction, well, that's certainly going to affect their confidence and also potentially have negative wealth effects instead of the positive ones that we're seeing now. And then also possible increases in personal income tax rates, which is also certainly something to keep an eye on in the context of the pressure our public finances is currently under. Okay, so let's fast forward the clock and let's move to the lower income grouping, if you wish. 4 reasons why, and very different to their counterparties, why their perception about their own finances are not that favourable. I've listed 4. I think the first one is very important. CPI inflation for this group, if you wish, is much higher than the official rate. Earlier on, the MC talked about unsecured debt. It's quite interesting what's happening there. Just by way of an example, there's much lower growth in social grant payments. And this group, during tough economic times, suffered from job insecurity, which is very different from high-income individuals. Corporates' approach is very simple. During tough economic conditions, they don't let skilled people go because they know it's going to cost them more to rehire them during tough economic conditions. Instead, high levels of job insecurity and job losses in the low income category. Maybe just a couple of slides to elaborate these 4 points. The picture on the left is CPI inflation. And I think a much better reflection for low-income earners, CPI, is the green line at the top. It's very simplistic. There we're looking at inflation for non-durable goods, in other words, food, transport, petrol obviously included in there. And you can clearly see that that level is much higher than the official country rate. You can get very detailed in your analysis, but I think that illustrates the point quite nicely. What is also interesting here is that that inflation rate is higher than the rate at which social grants is growing at today. So in real terms, many of these individuals, or at least those who receive social grants, is actually going backwards in real terms. Just think about that. The second point, sharp slowdown in unsecured credit extension. The orange line is total consumer demand for credit. It's a year-on-year growth rate, which is slowed down. But obviously, the interesting thing is the back line. After that bubble that we've seen in 2011, 2012, the year-on-year growth rate has come down dramatically. Right? No surprise there. What is interesting is that the peak was reached before interest rate hikes started in the beginning of the year. I mean, if you look at that picture, the peak in the black line was about early 2013, and interest rates only went up in the beginning of this year. Okay? So clearly banks started tightening their lending standards, probably worried about future non-performing loans, and has tightened their screening processes quite dramatically, and as a consequence the growth rate has come down quite sharply. There's no doubt that unsecured debt has facilitated a lot of consumer spending over the last couple of years, so to the extent that growth is slowing down, obviously it will have an impact on spending. This is just a picture talking or showing you at least what is happening with regards to social grant payments. The blue line, year-on-year growth, yes, it is still growing about 8%, but it's not 10 and 12% anymore. So growth in social grant payments is slowing. And the reason it is slowing is because of the green line. And the green line shows you the growth rate in the number of beneficiaries. So since 2008, it's been growing about 5 or 6% per annum. And the National Treasury will tell us that we can't sustain that growth rate, and then instead that growth rate must slow to about 2.5% or so over the next couple of years. That's the reason why the blue line is trending down. Right. So look at that 8% growth rate in social grant payments, and then just flip back 1 or 2 slides and think about the inflation that this group experienced, much higher than CPI inflation. And I think you can explain a couple of things in South Africa. Okay, consumers moving into corporates, and remember the theme, spot the divergence. Talk about disconnect. Well, there's the striking. What you're looking at here is bank lending to consumers versus corporates. And this is the year-on-year growth rate. So you're familiar with the blue line. I've showed you that against unsecured debt. Look at this divergence. Corporates are borrowing at a rate of 20% year on year. Consumers are borrowing at a rate of less than 5%. So what's going on here? Right? I thought the economic outlook is poor, and I thought that things are so dismal, confidence levels are low, etc., etc., and yet we've seen quite a significant pickup in corporate borrowings. Okay? What is interesting is that we know that some of these borrowings are being utilized in fixed investment locally. Right? If you look at the green bar shows you the growth rate in private sector fixed investment. It's real, so it's adjusted for inflation. So we're seeing private sector fixed investment over the last couple of years growing at about 3 or 4% per annum. Yes, there's an expansion. Yes, they're putting money into the economy, but obviously not at the 8 or 10% that we've seen going back to 2006, 7, 8, 11. Right, so there is fixed investment. Some of these borrowings are certainly being utilized in the economy. But once again, I kind of find it difficult to reconcile a year-on-year growth rate of 20% in bank debt to corporates with only 3 or 4% growth in fixed investment. Before I give you an explanation, I think that is quite important. Let's first establish this little bit of fixed investment that we are seeing from the corporates. What are they investing in? Here I'm using data from the central bank, and now I'm looking at fixed investment by asset. Okay, so here you look at investment in residential buildings, non-residential buildings, transport, machinery, construction works, IT, whatever the case is. It's rand billion. Once again, it is adjusted for inflation. Where's the action? Which bars are growing the most, or have done so over the last couple of years? The light blue and orange. Machinery and technology. Right? So a lot of the investment that we are seeing, a lot of the borrowings that companies are doing, is certainly being plowed back into technology, new systems, machinery, tools and equipment, with a focus on better controlling costs, with a focus on becoming more efficient and more productive, etc., etc. So the data is actually quite compelling on this. This, I think, is part of the puzzle. What you're looking at there, two lines. Once again, spot the disconnect or the divergence or the gap, the wedge, if you wish, between the blue line and the red line. And the blue line here is foreign direct investment into South Africa, so what foreigners are doing in SA. And the red line is what South African corporates are doing abroad. Okay? So the data goes back to 1995, and over that particular period, if you focus on the blue line, you'll see that foreigners have invested about 550 billion rand in SA. Foreign direct investment. After many, many years, the red line after many, many years of being flat, what is starting to happen? The red line is now starting to pick up pace. And slowly but surely are starting to close the gap. What is this telling you? It's telling you that in addition to investing in technology and efficiencies and cost controls, companies are also diversifying their asset base. Like individuals, like all of you sitting here, the advice that you're getting from financial planners is never to have all your eggs in one basket. Well, companies are very simply following the same advice. They're diversifying, and they're diversifying more and more abroad. From a geographical point of view, once again using central bank data, this is quite interesting. First of all, go back to December 2002. These are the countries South Africans, corporates, have invested in. 80% went to Europe. Fast forward the clock 10 years to 2012 and see how the colour scheme has changed over that particular decade. Which colours have grown in 2012? Purple and green. Asia and Africa. At the cost of, it seems, Europe. Right? So, quite interesting what corporates are up to. Alright. Let me conclude by talking to another disconnect, this time around in the property market. Okay? Earlier on, the MC made the point, how do you reconcile an economy that's growing at 1% year on year in the second quarter, the most recent data, with house price inflation that's starting to pick up, and confidence levels among building contractors in the residential market nicely above 50, which means that they are now more optimistic than they are pessimistic in that particular space. The top line, the top picture shows you a nice correlation between GDP growth and household consumption spending. If consumers are under pressure, the economy in aggregate will be under pressure. HCE is about 60% of GDP, so kind of positive correlation between the two lines makes perfect sense. So the economy is under pressure, and yet, if you look at F&B data, many of you will know John Luce, that is quite involved in this data. If you look at the picture on the left, F&B house price inflation since 2011 or so has slowly been grinding higher. At the same time, when growth in the economy has been slowing. And the reason why growth in the economy has been slowing, first and foremost, is because of slowing growth in consumption. The picture on the right shows you the confidence levels of residential building contractors. Interestingly enough, from about 2010 onwards, confidence levels also have been creeping higher, ever so slightly. The most recent data shows that that is above 50, which is in net positive territory. So once again, a question that I've been asking myself many times over this morning, what's going on? What explains this apparent disconnect or this divergence? I think a couple of things. Firstly, I've shown you this picture before where we looked at private sector fixed investment by asset, then we looked at it in rand billion. Now I'm showing you indices. So what I've done, I took the data, and I've calculated this as an index, and the index is equal to 100 in the third quarter of 2008, just before the global financial crisis struck. Then you can see what has happened to fixed investment in these different asset classes. Okay? So if you focus on the red line has been pretty steady at or around 100. What is interesting is the green line. This is no surprise to you because we already talked about that. Look at the sharp increase after sharp decline in investment in machinery. And I think this is part of the explanation, the blue line, as to why the residential property market is not doing too badly, or at least if you look at the data, while the economy is weak. Private sector fixed investment in residential property, after falling by about 30% during and shortly after the global financial crisis, there has been no investment for 4 or 5 years. In other words, there's a shortage of stock. Right? There's simply a shortage of stock. In other words, you can have a weak economy, and if shortage is, or if stock is in short supply, it's not going to take a lot of demand. It's not going to take a lot of demand and actually to push up house prices. I think this is what's happening. What is interesting, again, borrowing a slide from John at F&B, our sister company, it is pretty consistent with some of the results coming out of his own surveys. And what is interesting here is what they try to establish or measure is what percentage of real estate agents are citing stock constraints as a factor influencing activity in the real estate market. And what is interesting is that 1 in 5, 1 in 4 real estate agents currently are complaining of exactly that. I think these two pictures dovetail quite nicely. So, I think you've got one part of the explanation, and it sits with the supply, which in turn is a function of the lack of investment that we've seen over the last 4 or 5 years after a dramatic decline in residential property fixed investment post the global financial crisis. But I also think that there's good news on the demand side. Why do I say that when you look at that picture? That picture is year-on-year growth in mortgage demand. Yes, it picked up a little bit from late 2011 onwards, but it has been flat as a pancake for the last 2-3 years or so. Year-on-year growth has been stuck at about 3 or 4%, if I'm not mistaken. And yet I'm saying banks are becoming a little bit more lenient in issuing bank loans for mortgages. Of course, the variable you should be looking at is not that one. What you should be looking at is the rand value of new loans granted by banks. Right? New residential mortgage loans paid out over the last year or so have improved quite a lot. In the first quarter of 2013, it was about 44 billion rand in that quarter, and it has picked up in the first quarter of 2014 to about 55 billion rand per quarter. So it is clear that banks indeed are becoming a little bit more lenient. It is creating a little bit of demand at a time when supply is relatively tight. I've taken 40 minutes. Do I have another 5 minutes, I think?
I'll leave them to you.
Oh, okay. So, we've spoken a lot about disconnects, divergences. Initially, we talked about the external side of the economy, weak currency, and improving global growth was very unique. Then we talked about an interesting disconnect between travel payments and travel receipts in the tourism industry. I made the point that the industry is experiencing a boom. We talked about consumers. We've established that consumers are spending less on discretionary items, which is creating an interesting disconnect in the retail sales data. We also talked about how different income groups perceive their financial position 12 months in advance. We talked about different reasons why that is the case. I share with you a couple of thoughts what corporates are up to in the context of the disconnect between accelerating growth in bank lending to corporates and decelerating growth in bank lending to consumers. And we also talked about the disconnect in property. So what is missing in any kind of macroeconomic conversation? Oh, by the way, I also expressed a brave view on interest rates. Brave because history is against us, and brave because currency is relatively weak, which seemed to have been a trigger for painful hiking cycles in the old days. So what's missing here is to express an opinion on the exchange rate, right? And if you think about wide probability bands, well, there are wide probability bands. The only thing I do know is that the currency is cheap. What I do know is that the currency is undervalued. And what I do know is that it is supposed to be undervalued and should stay undervalued. Why? Because currency weakness is part of what South Africa currently requires to rebalance. In other words, if you ask me, or put it differently, if the currency for whatever reason were now to go back to 7.50 or 8 against the US dollar, I will actually be pretty concerned about this. Because that's the last thing that SA needs from a business cycle point of view. Why do I make that statement? Well, this is really the crux of the matter. What you're looking at there, the red line, this is now in aggregate. So this is not only consumer spending, but this is now total gross domestic expenditure. The blue line is gross domestic product. It is rand trillions. The data goes back to 2000. What is interesting there, until recently, an interesting disconnect or divergence. Of late, the gap is starting to narrow. But what is very interesting is that over the last couple of years, spending has persistently grown at a faster pace than production. Okay? And that's never a sustainable situation. Economic theory is very simple. The difference between those two lines reflects your current account deficit. And earlier on I talked about that. In 2013 it was almost 6% of GDP. That cannot last. The gap needs to narrow. And then you have two choices here. You can either narrow the gap from the top down, or you can narrow the gap from the bottom up. Now, so far, I showed you that export volumes are picking up, but not as quickly as you would have thought, given all the other constraints. Right? So how are we starting to narrow the gap? It is clear through lower consumption. And the weak exchange rate will help, at least from my perspective, help narrow this imbalance from both ends. How come? Earlier I talked about it. Currency weakness is a double-edged sword. It leads to high inflation. Everything else constant, that will erode your real spending power. Growth in consumption will slow, and currency weakness, hopefully, will boost our export more with faster growth than has been the case up to this point. Hopefully, that's how we will narrow this gap over the next couple of years. In other words, to come back to the exchange rate, where will the rand be? I've got no clue. What is required is the rand to stay weak for some time. In other words, if you take the view that the currency is going to strengthen very quickly, that may well be. Is that the right thing for the economy and what the economy needs right now? If you follow this type of thinking, this line of thought, that's probably not what the economy needs. It is part and parcel of what is required to rebalance the economy so that in the process we can create a sounder footing to launch the next economic upswing. All right, I will leave it at that.
I was holding out for the banker. He applied for an overdraft of time, so I'm going to debit him for that. And then it was unauthorized, so I'm going to hit you again for that. But the good thing is now I can keep bucks on it, right?
Yes.
All right, we got 5 minutes just to take some questions. Ettienne can't stick around with us as we wanted him for the rest of the day. So can you put some questions to him? I've got the lovely Lynette with the microphone.
We've only looked at one side of the equation, which is your export side, and obviously you're exporting into a foreign market with a low currency, your exports are going to increase. But the counter to that is your imports. And you import it, and it looks like our imports are growing, which means that effectively you're going to be in a worse position.
Interestingly enough, the red line, obviously, the expenditure there will be slowing down on account of import growth. Because typically those two things go hand in hand. So if you think about consumers, growth of consumer spending is slowing down. And initially I made the point that it is particularly visible when it comes to spending on discretionary items. And most discretionary items are important. Think about motor vehicles, think about electrical appliances, TVs, whatever the case is. So to the extent that growth in consumer spending is already slow, particularly on those items, it reflects in slow growth. That being said, the counter to that would be a lot of the fixed investment that corporates are doing, IT machinery, are also on import. The balance, however, if you put it together, if you look at the year-on-year growth in total imports, it is actually slowing down. That's what that red line rolling over suggests. Right. So by industry, you have to be very selective and look at the detail because they can differ quite a lot in terms of what's happening.
Yes, jump in here. My property brain is ticking and saying industrial, warehousing, DCs, if we're moving a lot of boxes, tick, tick, tick.
Going back on the residential, over the demand and the supply, as much as I've seen on the slide that estate agents are saying there's a shortage or there's a shortage of supply, I'm a little bit puzzled because I'm looking at the side that I'm staying more on the south, Albert on that side. You're still seeing complexes in residential between price range of rental between 4,000 up to about 5,000, which are standing empty. And I don't know whether this was based probably on the north, where there is probably demand around that price. around that area, many complexes are actually empty around that prices. So I don't know whether that was based on the north only.
No, so it's a good question. The data that you're looking at there is in aggregate. So that is not specific to any location. So Aaron and I presume that you'll touch on these things a little bit later on. If you're forced to, right? So, and I'll leave that question really to the property experts to.
I'm going to take another question from the back there. But there's money coming into the residential sector. We've seen 4 billion in the listed sector buying residential property. Not necessarily new stock, but money is available. Got a question?
Although you didn't say it, I saw a slide there that said rand exchange rate to the dollar at 10 to 1 at the end of 2015. So are you saying that the trend of the rand will actually strengthen next year?
Yes.
That's one question. Second question, all that expenditure on machinery, does that not have something to do with a change in industry, buy machinery because of the labour issues that we have in this country?
Yeah, let me deal with that second question first. I think there are two things happening here. In the lead up to the global financial crisis, there was abundance. Right, too much of everything. The world economy was growing at 5%, the South African economy was growing at 5%. Interest rates were low, consumer spending was very strong, etc., etc. So typically during the good times, during the boom, what happened is that companies took their eye off the ball. A lot of fat crept into the system. Come the global financial crisis 2 or 3 years later, corporates had to fix many problems. Restructurings took place. A lot of time and effort was put in making the company lean and mean again. And in the process, many of our clients have neglected investing in machinery, tools, equipment, lubricants. So 5 years on, these machines have become old, worn, and not as efficient anymore, which means that many of these companies are simply forced to replace these equipment. Their competitors are doing the same. To stay in the technology game, you have no choice. So what has happened is that the depreciation rate has done this, while investment in machinery over the last couple of years has done this, which meant that capital stock started to shrink. And that in itself is never sustainable. So companies had to invest. That's one thing. Then there's also no doubt that some of the automation and the mechanization is driven by the situation of deteriorating labour relations. There's no doubt about that. So there is also an element of capital labour substitution. And there may be many reasons. Why a company are deciding to do that when it comes to specifically labour. Right? So I think it's a combination of those two things that is sitting behind this drive to hire capital equity, if you wish, more and more investment in machinery. As far as the currency is concerned, yes. At these kind of levels, if you think about rand dollar, we think the currency is a little bit oversold. That weakened a little bit too much. And that we wouldn't be surprised that over the next 12, 18 months or so, the rand will actually get back or recover a little bit against the dollar. Even if it does go back to the 10 rand kind of levels by the end of next year, the currency will still be undervalued. And remember, in the context of the earlier conversation, that is exactly what is still required. So the currency may recover a little bit, but at 10 rand against the dollar, it will still be relatively cheap. Cheap, so much so that it helps. Remember that double-edged sword kind of terminology? It helps to narrow that gap. Right?
Thank you very much, Ettienne. Let's get the Roux, Chief Economist from the Rand Merchant Bank Group.